Like most traders, you're smart, you're arrogant, and you think you can beat the market. Don't you? You think with enough time, you will outsmart people with billions of dollars, thousands of professionals, and several algorithms working 24/7 to capitalize on the smallest margin of inefficiency in the market. The blunt truth is, the market isn't there to make you rich. It's designed to transfer money from the naive, the inexperienced, the impatient, to the experienced, seasoned, and the patient traders. And if you're lucky, you'll break even. Let's face it, trading can be a wild ride, with promises of fast money, exciting highs, and some fancy cars to go with it. And who wouldn't want to give that a shot? But here is another honest truth. Most people will never make money from trading. In fact, statistically, over 90% of traders will end up losing money. But why is that? And more importantly, what can you do to become a part of the coveted very small percentage of profitable traders? In this video, I will reveal the unfiltered truth you've never heard anywhere else, the reason you'll fail to profit from trading, and the truth of what you can do to join the less than 10% profitable traders club and reap the sweet rewards of trading. Chapter 1. The reality of trading. Most traders fail to profit from trading, and the reason lies in a fundamental misunderstanding of what trading truly entails. The glamorous perception of fast, easy money draws many in, but the reality is far from it. Here's what you need to know about the harsh realities of trading that few will tell you. 1. High competition. Let's say you want to trade a popular forex pair, like Euro-USD, in hopes of profiting from small price changes. The forex market is heavily dominated by large banks and institutional investors like JP Morgan, Citibank, and Deutsche Bank. These institutions aren't just trading manually. They're using high-frequency algorithms and advanced analytics to gain tiny advantages in price changes, which they exploit thousands of times per second. Big banks have access to vast sums of capital and benefit from something called flow trading, where they trade against orders from other market participants. With this information, banks can see a large amount of buying or selling interest in real time, allowing them to predict where the price might head next and to capitalize on it before the market even reacts. Retail traders, like you and I, don't have access to this level of insight or speed, often making us price takers rather than price makers. To make matters worse, many forex platforms provide retail traders with delayed or less precise data than what banks have access to. Banks often execute their orders directly within the interbank market, getting the best available prices, while retail traders are frequently left paying higher spread costs, especially during high volatility. This competitive advantage for banks and big institutions, along with access to superior tools and market data, makes forex trading an incredibly challenging environment for retail traders to consistently profit. 2. The emotional roller coaster. Consider the market crash in March 2020 when the pandemic hit. Stock prices plummeted, and many retail investors panicked. Instead of holding or even buying at low prices, countless traders sold off their stocks, locking in massive losses. When the market rebounded faster than anticipated, many were left on the sidelines, missing out on one of the fastest recoveries in history. This emotional reaction to fear is common among retail traders and investors. On the flip side, greed can be just as dangerous. Imagine buying Bitcoin in December 2017, when it reached an all-time high of nearly $20,000. Driven by FOMO, many bought at this peak, and within weeks, Bitcoin's price dropped by over 50%, leading to substantial losses for those who didn't set realistic exit points. These reactions happen frequently and reflect how emotional responses to price swings can erode profits. 3. Short-term versus long-term thinking. Many new traders come into the market believing they can get rich quickly, focusing on making a large return in a short period rather than a steady long-term approach. This mindset leads to high-risk trades, often without proper research or understanding of the underlying asset's fundamentals. Take the example of penny stocks. These stocks often see massive fluctuations in short periods, attracting traders looking to double their money overnight. However, these stocks are also incredibly volatile and frequently lack liquidity, making it difficult to sell them at desired prices. Many of these traders end up with shares that are nearly impossible to offload without significant losses. Successful trading often requires a long-term view. In 2021, many new traders bought into the hype of meme stocks like AMC and GameStop, expecting to make a quick profit. While a few managed to cash out at the peak, many held on too long, expecting the stock to rise indefinitely, and when prices inevitably dropped, they were left holding shares worth far less than they had initially paid. 4. Hidden costs. Trading costs can be surprisingly high, especially for those who trade frequently. Even if your broker advertises commission-free trading, there are often hidden fees and costs that eat into your profits. One example is the spread between the buy and sell price. Even if there's no commission, trading platforms make money by selling at a higher price than they buy, so you're always at a slight disadvantage when executing a trade. Over time, especially with frequent trading, these small costs add up. There are also potential fees for things like currency conversion if you're trading in markets outside your home country. Between high competition, emotional challenges, short-term thinking, plus hidden costs, trading presents numerous obstacles that make consistent profits difficult to achieve. Chapter 2. The statistics are against you. Every January 1st, Teddy is always filled with optimism. He'd line up a list of resolutions as grand and ambitious as anyone's. He wasn't alone, of course. The gym was always packed that first week, with everyone's hopes and dreams practically sweating off the walls. It was almost contagious. But by February, Teddy noticed the change. The gym that had once been filled with eager faces and fresh sneakers looked a little emptier every day. The regulars were back to their routines, and the resolution crowd had dwindled. Teddy's own enthusiasm had started to dip too. A skipped workout here, and I'll go tomorrow there. He could feel the familiar slump settling in. Yet, determined to make this year different, he tried everything. Motivational apps, accountability partners, even a flashy new gym outfit he told himself would keep him inspired. But deep down, he knew the excitement was fading. It was the same story every year. By March, the only part of his gym bag getting a workout was the dust piling up on it. Then one day, Teddy bumped into an old friend, Sam, who had actually stuck with his resolution the year before. "What's your secret?" he asked, exasperated. He shrugged. "There isn't one. I just kept going, even when I didn't feel like it. There was no magic day where it got easy. I just stopped waiting to feel motivated." That simple advice stuck with him. Teddy realized his failure wasn't unique. He'd just been waiting for some burst of motivation that will never come. In truth, 90% of people failed because they let the inevitable slumps make them quit. So Teddy dusted off his gym bag, not expecting inspiration or instant results. Just a small, steady change. He went to the gym that evening, feeling no thrill, no spark, but just the tiniest bit of progress. Wondering how a New Year's resolution story about the gym relates to trading? The answer is simple. We are all like Teddy. Trading, like fitness, is easy to start but hard to stick with. And here's a reminder of the stat to back it up. Over 90% of retail traders lose money. This isn't just bad luck. It's the same cycle of optimism, frustration, and quitting when things get tough. Trading often starts with that same optimism. A fresh start, a quick win, or a new strategy that feels like the magic ticket. But when things get hard, the reality sets in, and without steady discipline, most traders lose the excitement, then the money, and finally the will to continue. So, what's the real takeaway? Whether you're setting a new fitness goal or diving into trading, success isn't about hype. It's about building habits, taking small steady steps, and showing up even when the thrill wears off. Because in the end, The ones who succeed are the ones who refuse to quit when things get tough. And that is an honest truth about becoming a profitable trader no one will ever tell you. Chapter 3. Common pitfalls that lead to losses. Lisa started her day with precision. She was going long and short on Dogecoin, and her trading strategy yielded early wins that made her feel invincible. But the thrill of success clouded her judgment. She chased impulsive trades, betting on fleeting signals and ignoring her rules. By afternoon, the market turned volatile when Elon Musk tweeted about Dogecoin. Her once disciplined approach unraveled as losses snowballed. By the end of the day, her early gains had vanished, replaced by the cold, bitter lesson of overtrading. Lisa stared at the red numbers on her screen, realizing she hadn't just lost money, she had lost control. What happened to Lisa has happened to all of us on our trading journey. This trap she fell into is a common trap for traders called overtrading. Overtrading is a mistake that both beginners and seasoned traders often fall into. The excitement of placing trades and the allure of quick profits can make it easy to jump into multiple trades in a day, often chasing small price changes. But overtrading carries serious downsides. 1. The rising transaction costs. Every trade has a cost, whether it's a commission fee or the platform spread, even if it's advertised as commission-free. While these fees might seem minor for each trade, they add up fast. For example, if you make 10 trades in a day at $1 fee per trade, that's $10 a day or $200 a month gone to fees alone. 2. Increased exposure to volatility. The more you trade, the more vulnerable you are to the market's fluctuations. On volatile days, it's tempting to jump in and out, hoping to time the perfect entry or exit. But this frequent trading amplifies risk, and a sudden market swing in the wrong direction can wipe out your gains or worse. 3. Emotional burnout and poor decisions. Trading too much can wear you out emotionally, leading to decision fatigue. This happens when the mental effort of analyzing, predicting, and reacting to the market overwhelms you. Over time, your decisions may become impulsive or poorly thought out, increasing your chances of costly mistakes. 4. Ignoring risk management. Many traders focus on how much they could win and forget about the potential losses. Without proper risk management, like setting stop losses, avoiding over-leveraging, or diversifying trades, you're leaving your portfolio exposed to unnecessary risks. Being mindful of these common mistakes can help traders protect their capital and make smarter decisions. At this stage, it's clear that there are lots of things that can trip you up in your trading journey. From the billion-dollar competitions to your own human emotions of greed and fear, it's clear now why just less than 10% of traders profit. I know you're wondering how you can become a profitable trader. Well, the honest truth of how to become a profitable trader is what you will discover in the next and final chapter. Chapter 4. How to become a profitable trader. If trading isn't straightforward and typically doesn't lead to wealth for most individuals, what are your alternatives? Here are some strategies that could prove more effective than whatever it is you've been doing all these while. 1. Educate yourself in finance. Knowledge is your most powerful tool when it comes to managing trading and investments effectively. When you enhance your understanding of financial concepts, you equip yourself to make informed and confident decisions. Start with the basics of financial literacy. Grasp key concepts such as budgeting, saving, and the importance of compounding. Expand your learning to include how financial markets operate, the roles of various investment vehicles, and the factors that drive market movements like economic news, events, and calendars. Dive deeper into risk management strategies, including diversification, position sizing, and the use of stop-loss orders to protect your portfolio from unnecessary losses. Exploring educational resources such as books like Mark Douglas's Trading in the Zone, The Intelligent Investor by Benjamin Graham, online courses, and trusted financial websites like Investopedia will help you build a strong foundation. Additionally, stay updated on current market trends and economic news, as these can significantly impact your trades and investments. The more you understand, the better prepared you'll be to navigate the complexities of trading and long-term investing with confidence. 2. Focus on the long term. While day trading may seem like a fast track to wealth, the reality is often quite different. Many traders end up losing more money than they earn, finding the process both challenging and emotionally taxing. Instead of chasing daily trades, shift your focus to higher time frames, such as the 4-hour or daily charts. This approach naturally reduces the frequency of trades to 1 or 2 a week, or even fewer. This helps you save on fees and minimize the emotional roller coaster of constant decision-making. You can also consider long-term investing in more stable options like ETFs, index funds, or bonds. While these investments won't make you wealthy overnight, they provide a safer and more reliable pathway to growing your wealth over time. 3. Practice before jumping in. If day trading still appeals to you, it's crucial to build your skills and confidence before risking actual money. A great way to do this is by practicing with demo trading. Demo or paper trading simulates real market conditions, allowing you to place trades and manage a virtual portfolio without using real funds. This hands-on experience helps you understand how markets fluctuate and react to various factors, giving you invaluable practice in analyzing trends and making strategic decisions. Platforms like the TradingView website offer demo trading tools where you can test different strategies in real-time market scenarios. These simulations enable you to experiment with concepts such as technical analysis, order types, and risk management without financial consequences. With paper or demo trading, you not only refine your trading strategies, but also gain a deeper understanding of your emotional responses to wins and losses. This practice helps you build discipline, reduce impulsive decisions, and prepare for the psychological demands of live trading. It's an essential step for anyone serious about entering the world of trading with a solid foundation. Although it must be said that trading with real money is another beast entirely. 4. Get a job and invest in skill building. One of the most rewarding and reliable investments you can make isn't in the market or any financial asset. It is in yourself. I often encounter people who do not have a full-time job, but want to trade full-time. And I tell them that it's unlikely they will profit from trading alone. And this is an honest truth about trading that most people are not ready to accept. Successful trading requires stability and a buffer against the emotional highs and lows of the market. You need an additional source of reliable income to shield you from the unpredictable nature of trading. This provides financial security beyond your trading endeavors. And this, in turn, helps you completely detach emotionally from the outcome of your trades. It also helps you make rational, logical, and better decisions over time in the markets. Enhancing your skills and expertise can significantly increase your earning potential, open up new opportunities, and create financial stability that isn't tied to the ups and downs of market volatility. Start by focusing on professional development within your career. Identify key skills that are in demand in your industry and pursue training or certifications to sharpen your abilities. Whether it's mastering technical skills, improving your leadership capabilities, or learning a new language, these investments in your career can lead to promotions, salary increases, or better job opportunities. Beyond your primary career, consider launching a side business or freelancing in an area you're passionate about. Whether it's consulting, writing, or developing an online business like a YouTube channel, creating an additional income stream diversifies your financial portfolio and offers a degree of independence. Finally, invest in personal growth. This might include improving your financial literacy, learning negotiation skills, or building your network of professional connections. The returns on these investments go beyond money. They empower you with the knowledge, confidence, and resilience to navigate life's challenges and opportunities. Trading is complex and filled with challenges that most won't overcome without the right mindset, education, and strategies. And if you don't know already, the market doesn't owe anyone success. It rewards those who are disciplined, informed, and prepared for both wins and losses. If you're serious about improving as a trader, I will recommend you watch this video about the secret habits of successful traders. and what they do differently. Don't forget to like, subscribe, and share if you found this video helpful. And until next time, keep learning, stay disciplined, and never stop growing.